Good morning, everyone, or good afternoon or good evening, depending on where you are in the world. Thank you very much for joining today's webinar on warehousing and logistics. For those of you who don't know me, I'm Florian Tamm, real estate partner at the Frankfurt office of Baker McKenzie and chair of our EMEA real estate practice group. When we started preparing this webinar, the world around us was actually quite different. Within a few weeks only, markets have changed heavily, impacted by rising interest rates and inflation, let alone Russia's invasion of Ukraine. For obvious reasons, this has also an impact on warehouse and logistics assets, especially on valuation and rent affordability, which we will also touch upon during today's webinar. We are very fortunate to be joined today by two external contributors, as well as a panel of experts within Baker McKenzie. Our webinar will begin with a market update from Marcus de Minckwitz, who's EMEA head of industrial and logistics at Savills. Marcus will then join our group panel discussion of topical logistics issues. Let me briefly introduce you our other panelists. Michael Smith is president of First Mile Refrigerated Ventures, a US private equity firm investing into cold storage and processing facilities. Michael is the former head of our North America real estate practice. He will talk about his journey from a real estate lawyer to logistics specialist, sharing some of the things he has learned along the way. Next is Mike Webster, construction partner in the Baker McKenzie's London office. He will speak about some of the key construction considerations when developing logistic projects. Next is Ben Forner, our lead partner for real estate and sustainability. He will talk about some legal ESG considerations for logistics projects. And finally, I will be adding my expertise on real estate joint ventures for warehousing and logistics projects. Our panel discussion and Q&A later on at the end of the session will be chaired by Catherine Lang, who is the knowledge lawyer responsible for our EMEA real estate practice. Before we start, just a few minor housekeeping points. The session will be recorded and will be made available to the participants after the session. All participants are muted and in listen-only mode. However, we do want to be this an interactive session, and I would encourage you to ask any questions you may have via the Q&A function at the bottom of your screen. We will answer as many of your questions as time allows during our Q&A at the end of the session. But please feel free to pose any questions during any time of today's webinar. With this, I would like to hand over to you, Marcus, please, and the floor is yours.
Thank you very much, and good afternoon, everyone. So yeah, as Florian said, I head the EMEA Industrial and Logistics division at Savills, and that's kind of covering pretty much every major market across the region, with about 150 transaction guys split between capital markets and leasing, and then the wider service lines beyond that. My day job is capital markets. That's my background, and we'll talk as much as I can around that, but also the everything else we're seeing in the occupational markets, construction markets as well. I don't know if I'm driving this or if we can go through to the next slide. So just a bit of a backdrop, and please recognize I'm as aware as anyone that a lot of the positive messages we put up on screen are changing. I still think there's lots of positives we can draw from it, but the world has changed a lot quicker than perhaps people expected it to. But the backdrop to all of this is that for the last few years, every time we stood up and given one of these presentations, it was another record breaker, and last year was no different. And we saw around 40 million of square meters in take up, and the investment market really boomed. I mean, coming out of COVID, investment volumes that total in Europe were relatively stagnant, but logistics hit 26% of total investment volume, whereas back in the day, logistics was kind of a bit of a minnow. It would be more like 10%. That gives you kind of a sense of the rise of the market in terms of the investor appetite and perception. As we go through, though, to the next slide, we are probably all aware on the webinar in terms of where some of the tailwinds have come from. Principally the rise of e-commerce over the last 10, 15 years in Europe, that it's really taken off. And I won't dwell too much on those because I think that they've been well trodden in terms of presentations. I think really it's the headwinds that we're now facing. Inflation, build costs, Ukraine, you see them down there. The one point I would mention there is nothing in those headwinds is specific to logistics. These are macro issues that we're all having to deal with. And the point of that being is we still need to look at logistics on a relative basis. There's been a lot of negative press over the last couple of weeks from some certain outlets that almost feel as though logistics is being the hardest hit. I think there's a lot of reasons why still on a relative basis it looks like a very good space to be active. Obviously we're slightly more exposed in certain areas, but generally these are macro issues. And this is kind of the biggest one I think we're all dealing with, and it touches us in a number of different ways. I think right now it's inflation bringing on increased interest rates, and also how the markets are reacting to that with swap rates moving out. I mean, quite simply, if your all-in debt cost is at 4, selling X growth sheds or long leased sheds where you can't access the growth in the 3s, it doesn't necessarily add up. And that's why markets like Germany and the Netherlands, where those yields have hit those low 3s, even 2s levels, are being some of the hardest hit right now as we deal with it. The other key bit with the inflation piece has been on build costs. And there's a section on this, but there's a highlight here that steel prices have gone 3 times pre-COVID levels. And that is really impacting developers right now. The other bit coming from the other way is consumer confidence. And I think if you press again, a graph will come up. And again, the lines will come through. Consumer confidence is at a record low, and history suggests that when it reaches this point, we're about to go into a recession. Consumer confidence impact on the logistics market is key. We can't get away from about 65% of the logistics market is some way related to retail, be it retailers occupying the sheds themselves, or 3PLs, or people providing for the retail markets. So this is going to impact us, and don't worry about having to go back, but we are going to see fragility amongst the occupier base. And right at the edges with our agency teams now, we're seeing decisions being delayed, growth plans being reviewed. I think there's a lot of room in our market for some turbulence, and we'll come on to some of those dynamics. But I think it would be remiss of us not to accept that we're going to see some of those issues play out. Just touching slightly on consumer confidence, Amazon as a key leader within the logistics market, and the news that came out from an earnings call about a month ago from them saying that they were kind of overexpanded and had seen a loss for the first time. We've unpicked quite a bit of that, and they've certainly overexpanded in the US. It's a much bigger issue out there. I think Europe, they were a little bit earlier, and it was just not anywhere so far as exposed. But it's inevitable that business was going to mature at some point. We should expect some changes to their growth plans going forward. This bit then on the build costs, sorry, just going back then to the build costs, this is what the developers have really been faced with. The good thing is that it's kind of started to stabilize at the moment, but you can see in Q1 this year, often projects we were involved with, build costs going 30, 40% higher. With yields moving out as well, then you can only really look to your rent to try and make up some of those gaps and some of those shortfalls. And the rents can only do so much. The other tap that has kind of been turned off in the last week or two is development finance. That is becoming really hard to access. So I think for development, they're in for, some tough times ahead, just in terms of bringing stuff through and getting it out the ground. Obviously, that has a positive impact on standing stock and rental growth, but it's probably one of the biggest issues we face in the sector at the moment in terms of how are we going to satisfy this demand. And that point, isn't explained better than this chart at the moment, that requirement levels are rising. I made the point that people are, slightly questioning decisions and certainly reviewing things. But leading up to this, we have seen requirements only kind of rise and get bigger. One of the biggest points to make on this slide is that over 52% of requirements are for 500,000 square foot plus sheds in the UK right now. Big boxes that people are looking to take. And also those buildings are becoming more bespoke, a lot more user specific, and the sector itself is maturing a lot in that regard. And I think we'll hear from Michael a bit about that as well. And the other point to make as a positive is that this long-term structural change is still expected to play out over the next 10, 15, 20 years. The shift to online, in spite of what we're experiencing in the economies, is not expected to change much. We've asked certain experts in the industry as to where they think online might get to as a percentage of total sales, and quite a few are confident that it could reach 50%. In reality, it's probably already at about 90% in terms of the number of touch points that we use online or e-commerce for, even if that's going, reviewing something online and then going picking it up from store. So online is everywhere. General rule of thumb is that more online retail means more demand for warehouse space. So we're pretty confident in the long-term trajectory for the sector. Last year we started a census which was targeting occupiers, landlords, developers, investors into this space, any stakeholders really, to start to get a sense of the mood music and what's important to those people. We'll touch a little bit on the results here. It'll be fascinating as we're going to go through this exercise again this summer to see what the changes have been in the last 12 months. But I think some of the key messages will still come through. And as we go through to the next slide, generally, the majority of occupiers are in expansion mode. And that's the bit we're going to be keeping a really close eye on over the next 3 to 6 months as to how that changes. You can see across pretty much all markets, and in all cases, this market is still expanding from an occupier base. And the biggest bit here is that it's also a diversified occupier base. I think some of the issues around the other sectors, and I come from a background of retail where you only really ever have 40 to 50 key tenants. That's who you're focused on and who you're worrying about. And retailers, have a habit of going bust and recycling. So you're expecting that shift and that change. And also, I think that's when you're appraising retail property, you're very, very keen to look at trading performance and general local dynamics. At the moment, logistics offers up something that's a lot more diverse and a lot more spread in that risk. I think that will change, and we're going to have to, especially with these bespoke buildings, we're going to have to look more to trading performance, more to the importance of them. But you do have a more diversified risk basis across the sector. And to that point as well, it's not just about e-commerce. We've done a paper to show as well that, more manufacturing investment creates a great need for more warehouse space. On top of that, you have deglobalization, nearshoring. So there's lots of pointers in all of this that think that we're going to need more warehouse space. And as a result of that, we saw take-up peak last year, and that was a big bounce up to 40 million square meters. One of the concerns as we came into this year is how are we going to reach that numbers, not because of demand, but because of supply. And with challenges in development, that's going to be even harder going forward. Thanks. I think this just shows, which you'll probably all be aware of, where the majority of that take up is. I think the key bit to highlight that is often gets lost as well is just how big and important Poland is to the logistics market in Europe now. And that is still the case. The occupier markets are still pretty active in spite of what's gone on in Ukraine. And also, for the majority of Polish warehousing, you're actually buying into the Western European consumer market. If you think what Amazon have done out there with, the fulfillment centers they've built right from the north all the way through to the south into Slovakia and Czech Republic, that is, they call it the banana, but in fact that's a network of Amazon fulfillment centers for predominantly the German market, taking advantage of the cheaper labor rates. So the interconnectivity here between all of these markets, it is one logistics market in our view. And this kind of is one of the biggest slides that we look at in terms of vacancy rates. And the average vacancy rate going down to 3.3%. But when you get into the core markets, Madrid, Barcelona, London, Paris, that is often trending, below 1%. And with limited spec development coming through, development in total, we think those markets, that's going to be really, really kept low. I think the point of this for us is that for all of our tracking back and looking through the history books, anything below a 12%, call it a 10% vacancy rate, we would term a landlord-friendly market. So there's a huge amount of headwind in these numbers for the turbulence that I talked about before we really start to get away from what is a positive trajectory. And then that leads into rental growth. And for a long time, I guess we, together with a number of our clients, have been slightly frustrated with what the forecast houses have been predicting in terms of rental growth. And I think a lot of it is because, your capital economics of this world look at macroeconomic factors and mainly inflation, and kind of misses the point on the real estate. And we have consistently proven that they massively undervalue the relationship between supply and demand, and these forecasts are just outwardly wrong. In certain markets already this year, we've seen 10, 15, even 20% rental growth. And that is really holding up the sector, if you like, and helping investors kind of counter some of the issues elsewhere, not least rising debt costs. And this kind of proves that point. The forecasts versus reality when you do a deep dive into each of the UK markets. And you can see London there, forecast at 2, but trending above 8, and that's a market that kind of over the last 5-10 years has been broadly around 10% per annum in terms of growth. And this is really helpful for clients. Sorry, just to finish on that, it's really helpful for clients trying to underwrite opportunities in stiff competition. This data really, really helps them put those growth rates necessary to try and be competitive. Final bit on this is that I get some kind of comfort from the fact that the people applying the biggest growth rates tend to be the biggest owners, Seagrove, Prologis, Blackstone, because they see it in their own portfolios. I think if these growth rates were being projected by newcomers just desperate to get a foothold in the market, then it would be greater cause for concern. But it's from real life evidence and what they're seeing that these these forecasts come from. And this kind of proves the point for us in terms of how vacancy rates support this view on rental growth. From the census, one of the biggest things that we noticed when we asked what primary concern was to everyone was the lack of supply and challenges in securing warehouse space. Now, I think this is going to just play out even more, and we're doing a study at the moment on rent affordability that anyone would be welcome to talk to us about, because you would expect it, but a lot of investors have said, okay, fine, you're showing us amazing rental growth forecasts, but can these tenants actually afford when we saw rental growth in the retail market, for example, after so long, the tenants turned around and said, sorry, this just doesn't work for us anymore. Now, the point for this is that actually, because rent is such a low proportion of cost, then the right size, the right place real estate is worth that additional expense because of savings you can make elsewhere. So I think it actually moves away from being about rent affordability, just cost management, and how better located real estate sells you on transport, on labour, on even energy, which are much, much bigger costs when you look at these businesses. Moving on to the capital markets, then, and as I mentioned this previously, we saw a record year last year, and you can see the trajectory there. There is still a huge amount of money chasing logistics. Of all the meetings that I've had over the last 2-3 weeks, the sales we've got in the market, no one has yet said that they're reducing their exposure or there's less appetite to invest. They also kind of believe in the business plans, they believe in the growth, they recognise the forecast, the rent's going higher. The issue is entry and exit. It's really hard to pinpoint, what you should be buying these for, what will remain competitive, what sellers will sell for, but also what are you going to be selling it for in 5 years? Or what market are you going to be coming back out in? What's the average prime yield going to be? And that's causing a lot of question marks at the moment. There's a lot of retrading going on. There's a lot of sellers questioning, is now the right time to sell? And that could suppress transaction volumes because we might just go through a period of stagnation. Now, I think all of us are kind of willing this downturn, whatever it might look like, to be quite quick. And that seems to be a general consensus. But it's just, do we get out of that later this year? Is it going to run into next year? And I think transaction volumes generally are going to be a little bit reliant on the outcome of some of those debates. And then, coming on to then what that means in terms of value. So, your average rates kind of going to low 4. But obviously, as I said earlier on the call, Germany trended just below 3. Netherlands pretty much got down to that level. UK was at 3. We had a lot of yield compression very quickly last year. Now, as those prices come off, actually, when you look at prices today, we're probably back to June last year. And the good thing about that is it means that anyone buying or developing in kind of 18, 19, 20, 21 are still in the money and still in profit when it comes to making sales decisions, even though some of that super profit might have been eroded. And still, I think that keeps liquidity in the market. The issue then, obviously, if it turns negative, because the other people, decision for vendors to make is, well, okay, if I'm taking less money today, I'm also being told that I've got 5 years of pretty good rental growth to come through. So why don't I sit back and take advantage of that instead? And that's kind of, going to my point in terms of worry around some stagnation here. Without huge pressure points that could come, don't get me wrong, then, I think a lot of people are going to probably sit on their hands. And this kind of just touches then a little bit on these census results. So obviously lack of supply is the new problem, it's the biggest problem. And I think the interesting bit, if we just click through here, is the fact that ESG, just going back, amongst occupiers at least, ranked pretty lowly. They're still focusing on operational efficiencies and how to run their businesses. We're really interested to see where that gets to next year. But obviously, just going through this, if we click through, ESG was a much, much bigger factor for investors. And it seems to be more led by them at the moment. Location and permanent strength, you'd expect them to always be top 2 from an investor's eye. And I think, conclusions are there on the screen, but, let's get into that in the discussion and panel.
Thanks very much, Marcus. I think that was a really fascinating insight, and it's clear there's quite a lot of tensions out there, really, what with steel prices going through the roof, build costs very high, development finance hard to access, but those requirement levels continuing to rise. And I thought your slide showing the difference between forecast and reality of rental growth just was really interesting. I thought that really sort of put it into perspective. So thank you. That was really interesting. And now we're going to move to the next part of our webinar, which is a bit of a Q&A and a discussion amongst our great panel of experts that we have here. And as Florian said, please do use the Q&A button at the bottom of your screen to add any questions you might have. Do them anytime you think of them. We'll be keeping an eye on them, and we can pass them around the group as and when an opportune moment arises. So first of all, I'm really keen to hear from Michael. He's got a really interesting and unusual perspective to share with us, because as Florian mentioned, Michael was previously a lawyer. He was previously head of our North America real estate practice group, but he's now made a bit of a change. He's gone to the other side of the fence. So Michael, when you were a real estate lawyer, you were a bit of a generalist. You advised clients on all manner of assets, retail, hospitality, offices, infrastructure, but now you've moved to cold storage logistics. So perhaps you can tell us a bit more about your move to the other side of the fence, and maybe a bit more also about what you see as the differences between logistics and the other assets that you've dealt with in your career. And I know you've got some pictures, so I'm just teeing up Dominic to share those with us in a minute as well.
Great. So Marcus's presentation was like an examination of my soul, in the sense that everything he was describing was exactly what we're experiencing right now. When he showed his stresses, it was supply of product is incredibly tight. Zoning and entitlements is difficult to obtain in terms of a logistics facility. Energy is a key driver of these projects. And so your list of stresses was exactly the stresses that we're facing. So in terms of my path, we were focusing on very generalist type of, in a very specific space. We went from, we were focusing on food, right? And the food movement across essentially North America. And because that is one market. North and South America are one supply chain market for food purposes, in essence. And then Europe and Southern Hemisphere are a second market for movement of food. And then there's an Asian food market where food moves up and down north and south of the equator. And that's how food flows. In terms of the warehouse space, I'd like to, so we had bought up properties in Los Angeles, we bought properties in Chicago, we developed a cold storage facility in Denver, and we were doing very generalist type of work. And all of those tailwinds that Marcus was describing were driving our business. We had low interest rates, low cap rates, increasing cost of supply, land positions were hard to obtain, and so in December, we sold all of our assets just because we kind of saw the things that were happening. Our exit strategy was to identify land, try to focus on food and the food markets, and then if we weren't successful in that space, we would sell it off to Amazon, because Amazon was a continuous buyer of product. I think our decision ended up being pretty smart, because obviously what's happened recently, construction prices have gone way up. And so it's very difficult to get steel and the other materials that are necessary to build a facility. Amazon has contracted, and I can't say where that's going to take us, but it is in the North American market, it is a sea change in the warehouse and logistics business. And so I've moved, and we're focusing very specifically on an asset that I think will be just a case study in what Marcus was describing. So one of the key differences, Catherine, you mentioned what are the difference between logistics and other real estate. Most real estate, if you look at a retail facility or that circle's good. I like that. I was going to go to that back one down. If you look at a retail facility or a housing complex or an office building, you draw a circle around it and you say, what's the market that product is serving? And that circle is usually 5, 10 miles, 15 miles. In logistics, you get a circle like this. So the project we're working on is in Salinas, California. It's south of San Jose and San Francisco. And This is the 1-day drive period from that facility. We had a Amazon facility going in next to us, 2.5 million square feet Amazon facility, giant facility. And this is what they were looking at when they looked at this marketplace. They could get into Mexico, they could get up to Portland, over to Salt Lake City and serve 100 million people. And that's how they were looking at the site. So let's go to the next one. So we were focused on something a little different. Right. So the interesting thing to me about logistics is that it's really part of a supply chain, and you need to focus not necessarily on the real estate you're dealing with, but the entire supply chain from where the source of the product is to where it ultimately ends up. And your piece of real estate is only one piece within that supply chain. So we decided to get very focused on food, and to leave we were originally looking at the big markets, right? So you go to Denver and Dallas and Chicago and LA, and we were buying warehouse distribution facilities in the cold space for food to distribute in that local market. The problem with that, to me, is your universe of customers is much smaller, right? It feels like you're in a big market. Money says, oh, great, you're in a top tier market, we'd love to back you. But in reality, your universe of customers in that long supply chain is just the tip of the spear. So if I'm in Denver, I have 4 million people to serve, and that's really it out of my facility. So we went back to the other end of the supply chain, first mile logistics. And I put this chart up and you say, what is this picture? This picture is the Salinas Valley. And from that little green strip running down that road comes 70% of the lettuce of North America. Over 50% of the broccoli, most of the leafy vegetables that we have in the United States, at least about half, come from this little strip of land. And it's about 100 miles. And our property is at the tail. It says subject property. It's at the tail of that road. And so while it seems like a tertiary market, and that was the response of, and I can give the names, but a number of large funds that we were talking to about investing equity in the project, it seems like a tertiary market. When you look at logistics buildings, tertiary markets may be, especially at the first mile, they may be main and main. And the property, and if we flip to the next slide, this is Salinas. And Salinas is about 40,000 people, I think, but it shows an interesting picture. So Marcus was talking about zoning restrictions. Like the green belt around London, Salinas has farmland protection requirements. And they do that because this is some of the richest farmland in the world. And they surround the city with farms. They don't allow expansion. So what that does is it constrains the city itself. And if you look at that little white strip that runs along 183, those white roofs, those are all logistics buildings. And they're all serving the food business that flows from this space. There's 4 million square feet of cold storage in that town, that's a big number. There's over 4 billion a year that flows out of this town in food. That's the existing facility that we own. And as you can see, it's functionally obsolescent. And from this facility, this is really the only public refrigerated warehouse in the marketplace. And so we're building a replacement facility for this facility. What happens is food comes in off the field from that 100-mile strip. It has to get cooled through a pre-cooling facility, packaged, put into trucks that then travel across all of North America. That is how all the vegetables flow in North America. And so this is one of the facilities that we have under development. And as you can see, it's covered in photovoltaic cells. And then we have on-site cogeneration facility and gas facilities. And these are $500 million worth of infrastructure real estate that we're building. The value of this project, you see the photovoltaic, we've got a parking area. The values of this project is really the way it changes the price of food. So users, 45 years ago, there's a technology that came in place and it was essentially cold storage. And that allowed us to have vegetables all year round. And then they came with packaging products that allow you to have vegetables where oxygen, the way it flows through a package, allows you to have salads and vegetables in bags. Those were technological changes that happened. And now a new technological changes are happening. In energy prices, PG&E is $28 a kilowatt hour, which is pretty high. Because of the photovoltaic cells and the gas generation that we're able to use, these are high energy users. And so we're able to drive the cost down to about 12 cents a kilowatt hour. And that's $3.5–4 million a year of savings for each tenant operating out of one of these facilities per year. That's a big number. So if you apply Marcus's cap rates to that adds a little bit of value to the project through the energy savings. And then the trucking savings, the building needs to be built around trucks and how trucks can be brought in, staged, and moved out of the facility quickly. So those are, so I would say another key difference is logistical facilities are kind of operating facilities. They're operating facilities along this long chain. I love the project. It's the reason I like it, and it does some things that kind of a generalist investment in commercial real estate doesn't do. I have a market where there's a need, right? There is a need for new facilities, and so that means, and there is a barrier to entry in the sense that the governmental restrictions don't allow any other projects. We're the only project that's happening in the area, and so we have profit and we have barriers to entry. So I don't have to worry so much about those macro issues that Marcus was talking about. My project's still going to go through. And then lastly, there's purpose, right? If we do this well, we change the quality of food and the price of food throughout the whole supply chain. This will affect the price and the quality of food in New York and in Toronto and in Miami, right? And it's all starting in one little spot. And so that's a case study in what I'm doing in terms of logistics, but I think it's all of the trends that Marcus was describing are relevant here. We have real issues with pricing of materials, steel, photovoltaic cells. All of those things are at issue. But the interesting thing to me is that we may get, notwithstanding inflation, we may get price reductions in those products. So we were meeting yesterday with contractors, and we're very hopeful that our prices are actually going to come way down, because steel demand is in the cycle that we're going to be buying it. Hopefully, there isn't the demand for the Amazon warehouses and other warehousing and spec developments that were otherwise going on. Those things are all contracting everywhere else in the country. I know a number of guys who actually own Amazon warehouses, and one of them just got the keys back from Amazon. As I said, this had a 2.5 million square footer Amazon facility going up right next door, and they retracted from that facility, and that's in the last 2 months, right? So those are sea changes in the logistics space and demand space. So that's what I'm seeing. So Catherine, that's a long-winded answer to your question, but hopefully it's interesting to the group.
Oh, it's a great answer, Michael. And I'm just blown away by the percentage of leafy vegetables that are grown for the whole US, just in this small valley. It's mind blowing. And the fact that what you're doing here can affect food prices in New York. I think it's fascinating. And, I'd love to know what the figures are in other countries as well, in terms of, the small areas and, the wider ranging impacts that they have. I think it's fascinating. So thank you for that particular case study, Michael. And I'm going to whiz ahead, actually. I know you were going to talk about leasing considerations, but I think we'll turn to that a bit later if we've got time, because I'm conscious that our webinar is whizzing past. So I'm actually going to turn to Mike now to talk about construction, because I think this links in quite closely, doesn't it? And you've talked about what you're doing in the US, Michael, with that really sort of concrete example, and really good to see those pictures as well to bring it to life for us. So I wanted to sort of expand that worldwide and ask Mike about generally what he's seeing in terms of construction projects for warehousing and logistics. Are you seeing an increase, Mike, more globally in construction projects? And I feel like it almost goes without saying that that's probably been accelerated by COVID-19, but is that the case?
Thanks for that. I think so, yeah. I mean, I think the position really is very reflective of the story that we've already heard from Marcus and Michael, actually. So some consistent themes here. We have seen a lot of activity in the sector now for some years, and obviously based around the general trends of globalized supply chains, growth of online retail, and all of this, of course, given a further boost by COVID. but of course, the sector is a big sector. It covers lots of different industries, lots of different activities. So there is quite a wide range of construction solutions that may be needed for the different facilities. And I think one of the things we've seen is an increase in the more sort of technologically advanced facilities. So very much as Michael was illustrating there. So cold storage, automated warehousing, efficient energy provision. So, and I think these factors are partly driven by requirements for, obviously, for efficiency, for sustainability, partly also in reaction to labour shortages that we're seeing in quite a few markets as well. So I think all of these things have been progressing and changing and developing well. So it's an important area for the construction industry. But then we have the other issues that have also been touched on, which are causing problems generally for construction, and warehousing and logistics are not immune to this. So whether it's general supply chain issues, material shortages and delays, commodity pricing volatility, energy price increases. So all of these things are impacting the sector. So, I mean, I think just to sort of summarize, I think it is an important area. Developments are continuing. I think one of the interesting things is that they're continuing in a way to become more bespoke, more sophisticated, more interesting projects, which are also then giving rise to different procurement approaches. So sort of short to medium term, I guess we'll have to see what the impact of the current economic problems are, but it may well be, as Michael was indicating, that while it's generally bad news, the reduction in demand might be good news for some of those projects that do go ahead, but at the cost of others that don't.
Thanks, Mike. And I know you did mention procurement approaches there, so I'm just going to latch onto that and ask just a bit more detail on that. What changes are you seeing in procurement approaches for owners and developers?
Yeah, so I suppose going back a little while, we tended to see these sorts of projects being developed on either a traditional main contracting or a design build contract. So effectively owners and developers looking at single point responsibility, fixed price contracts and so on. So, you know, relatively straightforward approaches. But I think as these types of facilities get more complex, more bespoke, more specialized, that gives rise to a number of different factors and issues that owners and developers need to think about. And in some way, well, in most ways, it's an opportunity really for the owners and developers to think about, you know, what is it that's really important and how does the procurement approach help deliver that? You've obviously got the usual sort of time, cost, quality balance that, you know, you look for one and that has an impact on the others. So how you balance all that, how you balance the level of control you need. And all of this, I think, becomes more important the more technological the facility actually is. And one of the impacts, I think, of this is that we've been seeing a lot of these more complex projects now being carried out on a multiple contract basis, either using construction management techniques, or maybe just separating out the equipment supply from technology from civil and other work. So you're getting a more packaged approach. And so that gives you a lot more flexibility, but it gives you a number of potential issues that you then have to deal with. And I think when you're looking at these construction of complex facilities, there are a few sort of threshold issues. I mean, one of them is, you know, how much technology do you really want and need for the facility? What's the optimum point, given CapEx costs, given the potential sort of commercial way the market might operate, and your requirements may change. So, you know, is your technical solution sufficiently flexible and future-proofed? Is it proven technology to keep the lenders happy if you've got banks on board? And increasingly these days, what's the sort of lead time you have to look at in terms of ordering and delivering? So you sort of think about these things, decide if it's one single contract or multiple contracts. If you have a multiple contract approach, as we're seeing frequently now, then that inevitably gives rise to an interface risk. So the owner sort of trades off, if you like, the single point responsibility for different types of controls. And that gives advantages, but it also gives risk. Now you might want to do that in order to get your procurement timing right for long lead items, in order to fix pricing, in order to maintain tight control on design and fast track design and construction. You might want to have specialist testing, commissioning, performance type guarantee provisions from specialist installers. Or you might just want to avoid having a main contractor sticking a markup on very expensive equipment that's being procured through it. So lots of reasons to do it. But then in the contracts, you need to deal with that risk. And I think there's a mix of things we're seeing. I mean, one of them is contractual obligations, so straightforward risk allocation around coordination, collaboration between different packages, backed up by indemnities and other remedies. So there's a chunk of sort of legal protection that you can stick in there. We're also finding that contracts are becoming more project management based. So instead of just pushing risk across, they're including a lot more mechanisms as to how you deal with the risk. So that, and you see this in forms like NEC4 and even the FIDIC 2017 editions include these sorts of provisions. And then you need other practical methods, like appointing a construction manager or a project manager who can bring the skill set to avoid the problems, even if they don't then back that up with contractual liability if the problems arise. So I think all of these things are feeding into the procurement structures, and probably just a few other issues just to mention at a high level. Some of the risks are different then from the more traditional shed building, if you like. So things like delivery of equipment, passing of risk and title, payments, advance payments for off-site materials, testing, commissioning, performance guarantees, limits on liability. All of these areas of the contract have greater prominence now, I think, in the way that things are moving. And then layer on top of that all the other issues that we've been talking about. And just to give one sort of an illustration, we're working on some contracts at the moment where we're seeing contractors pushing back very strongly on fixing prices for commodities. They're saying we can't do it. It's, you know, we can only fix prices for days, if at all. We're seeing contractors looking for time and cost protection for any supply chain issues, whether it's the war in Ukraine, whether it's COVID impacting the Chinese ports, you know, the on-running spectre of Brexit, anything. So I think the dynamics in the market are quite different. So I think just to summarize on that, I think it's a very active, very interesting area, but constantly developing and becoming more bespoke and more complex and frankly more interesting as a result.
Thanks, Mike. I think that's really interesting, and I can really take away the complexity from that, and see how everything is becoming so interrelated, which really takes me on to Ben as our resident sustainability expert, because I can see that there's this layer of ESG factors coming in here. And I know Marcus mentioned that as one of the things that was coming out of the survey they did last year. And so I guess looking at development of logistics facilities and those ESG factors, Ben, how do developers tackle those differing ESG expectations of, say, an occupier of a logistics facility and perhaps a funder of that facility? How do those ESG expectations get married up in real life in a project?
Thanks, Catherine. Yeah, hi, everybody. It's a good question. I think it builds well on what Marcus and Mike have been saying. I was particularly interested to see the bit about Marcus's survey, how ESG for the investors is, pretty much right up there with other criteria, and that's what I've been seeing. And I think probably I'll just, by way of illustration, talk a little bit about, because we're limited on time, a little bit about a very recent transaction that we signed. It's a bit of a market busting development funding transaction signed last week for about 700,000 square foot logistics in the northwest of England. This was very much a deal where ESG was at the forefront of the funder's considerations, and actually almost undid the deal because the developer hadn't properly accommodated potential funders' ESG requirements into the structure, so into the pre-let, into the draft building contract, and this is a risk, I suppose, for speculative development, and it's interesting to see how Mike Smith's project was very much had that at the forefront and actually was driving the efficiencies and the value in that building, albeit there was limited other opportunity to do other types of development in that place. But in my particular case, ESG criteria, the ESG criteria of the funder, the investor in this development, were hard baked into the development funding agreement. So there was a set of ESG criteria. I'll just give you a couple of examples of them. The credentials of the building, they had to meet these to achieve PC, in order for the developer to get their earn out at the end of the project. So there was things like photovoltaic solar panels, LED lighting, rainwater harvesting, air source pumps, EV charging points, 10% minimum, energy monitoring systems, and crucially, and this is where we nearly came unstuck, was net zero carbon in operation. How was that going to be achieved as one of the key points for the funder? And there was a lot of discussion about what that really meant, and how that was to be achieved. And part of the problem was that this project was sold on the basis that it would be net zero carbon in operation in the brochure, and what turned out to be the case was that was never going to be achievable for the main warehouse section. It was only going to be achievable for the office section, and we had to unwind a lot of that, and in the end, because perhaps of the market, the state of the market, and the desperation, if I can put it that way, for funding in the last few weeks, we were able to force through a lot of changes into pre-agreed documentation to get our ESG credentials in. So we're able to get a net zero carbon in operation ready criteria, which basically meant through the design process, the developer had to ensure that that was going to be achievable when it was in operation. And then there was other things like we required the tenant to incorporate a lot of green lease provisions, sort of retrospectively incorporate a lot of green lease provisions in the pre-let agreement. and also other obligations about how they're procuring their energy. We wanted them to procure 100% energy, electricity from renewable sources, some of which we got in, some of which we didn't. But we're in a, it perhaps reflects the state of the market, but also reflects the need for developers to consider this, particularly on speculative development, but also where you're putting a pre-let in place. What are you agreeing with your tenant? Is this going to be a fundable development given investors, funders increasing ESG demands? So that's probably all I've got time to say at the moment, but it was an interesting case study.
Thanks, Ben. And I completely agree. I mean, I think it's fascinating that the ESG credentials had such teeth, because quite often these ESG requirements don't have teeth. It might be just, say, in a light green lease, just an obligation to collaborate, which doesn't really have a consequence in terms of a covenant breach if that doesn't happen, or a covenant breach where you would be willing to forfeit if that doesn't happen. But these ESG requirements were needed for PC to occur. So I think that's
and they had to be
change.
Built back into the building contract they'd already negotiated in the appointments to ensure that the certification that was necessary to achieve those credentials, the right people were there with the right instructions to do that job as well.
Thanks, Ben. Now, I'm conscious we're running short on time, and Paul Florian is keen to talk to us about joint ventures and the sort of looking up the chain in terms of how you actually structure these logistics transactions. But I fear, Florian, we only have 3 minutes. So I'm going to turn to you now for a very brief overview of this topic. Thank you.
Yeah, thank you very much, Catherine. And conscious of time, we're probably just focusing on the typical real estate joint venture structures. So for the ease of understanding, I've prepared a few slides which we'll also share with you afterwards. So tax optimized joint venture structures, in particular red blocker structures or market entry joint ventures, as you can see on the slides, are very popular, very common structures. There's an asset manager or developer who has the real estate expertise, the technical and cultural local know-how, who's typically holding between 1 and 15%. And there's an investor or capital provider who's typically holding the majority in the equity. So the choice of the JV entity and the structure is, of course, very much tax-driven. For foreign investors, Luxco structures with a Luxco PropCo and one or two-tier Luxco holding structure, as you can see on the slide, continue to be very popular despite of increasing substance requirements under the BEPS regimes. And then next slide, please. Then there are, of course, also classical 50-50 joint ventures with two equal joint venture partners holding 50% equity stake each. Sometimes both partners contribute assets. Sometimes one contributes the land only and the other the capital to develop the facilities. The challenge for these structures is usually how to minimize the real estate transfer tax burden when contributing the assets into the joint venture. Next slide, please. And then there are pooling joint ventures, which are similar to fund structures, where you have multiple joint venture partners pooling their investments, and there are obviously contractual arrangements around the shareholders agreement how to pool the investment. Last but not least, we also see an increasing number, there's no slide for that, but just mentioning increasing number of joint venture structures with no actually equity participation of the asset manager or operative joint venture partner, however you want to call it. In these scenarios, the operative joint venture partner has no equity stake, but all at stake, but the cooperation between the parties is only in the form of a contractual arrangement, such as a project development agreement, asset management agreement, or other contractual arrangements. The profit participation is in that case structured as a virtual carried interest or promote rather than via an equity participation with a proportional or disproportionate share in the profits in the distribution waterfall. The challenge for these type of joint ventures for the investor is to ensure that there is sufficient flesh in the game from the operative joint venture partner. The benefit for the operative joint venture partner is obviously that there's no need to inject equity. So very, very briefly, this was a kind of overview, and we have already reached the hour, unfortunately, and are also happy to take any question if time still permits. And I would hand over back to you, Catherine, to moderate the Q&A if we have maybe one or two questions still.
Thanks, Florian, for that whistle-stop tour. And I should reiterate what Florian said, that those slides will be included when we circulate some more information after the webinar, so you can look at those in a bit more detail at your leisure. I can see no further questions that we've had through the Q&A, but please, if anyone has anything, please do raise it. And otherwise, we will wrap up for today.
Yeah, unfortunately, we have already reached the hour and the end of today's webinar. The contact details of our speakers are included in the slides. I would like to thank you all for participating. A special thanks, of course, to you, Marcus and Michael, for joining us today, but also Mike, Ben, thank you for sharing your thoughts with us today. Thanks again all for joining, and hope to see you soon at one of our events. Thank you very much, and goodbye.